The biggest mistake retail investors make with individual stocks is not simply choosing the wrong company. It is falling in love with the stock after they buy it. At first, conviction is useful. You researched the business, built a thesis, and decided the risk was worth taking. The problem begins when conviction turns into identity. Now, instead of asking whether the business still deserves your capital, you start defending the stock because admitting the thesis changed feels like admitting you were wrong. That is where confirmation bias appears. Position sizes get too large, warning signs get ignored, and selling becomes emotionally difficult. You own the stock does not own you. And the first way to avoid that trap is understanding something every stock picker eventually learns. A great company can still be a terrible investment at the wrong price. A company can have brilliant management, strong revenue growth, high margins, and a powerful competitive advantage, and the stock can still disappoint you. Why? Because investment returns do not depend only on how good the business becomes. They also depend on what expectations were already embedded in the price when you bought it. Imagine a company grows earnings 20% per year. That sounds excellent, but if investors paid a valuation assuming 30% growth would continue indefinitely, 20% can actually be disappointing. This is the distinction between business quality and stock attractiveness. Quality matters, but valuation determines how much of that quality you are already paying for. So saying, "I love this company," is not a thesis. A real thesis needs to explain why the future business results could be better than what the market already expects. And that can be reduced to three very practical questions. Before I buy an individual stock, I want three questions answered. First, why should revenue grow? Maybe the industry is expanding. Maybe the company is gaining market share. Maybe new products are opening additional markets. Second, why should profits and free cash flow grow? Revenue without improving economics can create a bigger company without creating a better investment. And third, is today's valuation reasonable relative to that future? Those three questions force you to move from a story to a measurable investment thesis. Revenue, margins, cash flow, valuation. That does not guarantee you will be right, but it gives you something extremely important, a framework that can later be tested against reality. And once you own the stock, testing that framework objectively becomes much harder because the human brain is very good at searching for evidence that confirms what it already wants to believe. Confirmation bias becomes especially dangerous after you already own the stock. You'll watch bullish videos. You read positive analyst notes. You focus on the metric that improved. And when an uncomfortable piece of information appears, suddenly there is always an explanation for why it does not matter. Margins dropped, temporary. Competition increased, temporary. Free cash flow weakened, investment for future growth. Sometimes those explanations are completely valid. But if every negative development automatically receives a bullish explanation, you're no longer analyzing the stock, you're defending it. A better habit is deliberately searching for evidence that could prove your thesis wrong. What would I least want to see in the next earnings report? What competitor could actually damage this business? What metric would tell me the economics are deteriorating? And that mindset becomes even more important when the stock price starts falling. Because this is where another popular strategy can turn dangerous very quickly: averaging down. Buying more after a stock falls is not automatically smart or stupid. It depends on why the stock fell. Imagine the shares decline 30%, but revenue growth remains strong, margins are intact, the balance sheet is healthy, and the long-term thesis has not changed. If the valuation is now significantly more attractive, adding could make sense. But imagine the price fell because customers are leaving, margins are collapsing, debt is rising, and the competitive advantage is disappearing. The stock is cheaper, the business may not be. That is the crucial distinction. Lower price does not automatically mean better value. Before averaging down, ask yourself three questions. Why did the stock fall? Did the fundamentals change? And if I had no position today, would I still buy it with fresh cash? If the only reason you are adding is because you want to lower your average purchase price, you may simply be increasing exposure to a mistake. And how expensive that mistake becomes depends heavily on one number investors often underestimate: position size. Consider a simple $100,000 portfolio. If one stock represents 5% of the portfolio and then falls 50%, the total portfolio loses roughly 2.5% from that position. Painful, but manageable. Now imagine the same stock represents 40% of the portfolio. A 50% decline now removes 20% from your entire portfolio. Same company, same stock decline, completely different financial outcome. This is why high conviction should never automatically mean unlimited position size. Every individual stock contains risks you cannot perfectly predict: fraud, regulation, technology disruption, management failure, competition, a product problem. Sometimes the thesis breaks for reasons nobody saw coming. Position sizing is what prevents one mistake from becoming a portfolio disaster. Survival matters more than proving that your favorite idea was right. And once a large position is already sitting at a loss, another psychological trap begins: the desire to wait until you get back to even. If you want more stock analysis focused on decision-making instead of hype, subscribe to Boring Money Wins and hit the like button. The goal is not to avoid every losing investment. Nobody does that. The goal is to make sure one bad decision does not destroy years of good ones. And that becomes especially difficult once a loss already exists, because the next mistake sounds completely rational when you say it to yourself. I'll sell when the stock gets back to my purchase price. That sounds like patience, but economically it can be completely meaningless. Imagine you bought a stock at $100 and it now trades at $60. Your brain naturally wants $100 back, but the company does not know where you bought the shares. The market does not know. And the future value of the business has absolutely nothing to do with your personal break-even price. So the better question is not, when will this stock get back to $100? The better question is, if I had $60 of fresh cash today, would this stock still be my best place to invest it? If the answer is yes, holding may make sense. If the answer is no, waiting for break-even can create an opportunity cost. You may spend years holding a weaker investment simply because you are emotionally attached to an old purchase price. Your entry price matters for taxes and measuring your return. It does not determine the company's future value. And taxes themselves can create another reason investors refuse to make an economically sensible decision. Taxes absolutely matter in investing. If you sell a profitable position in a taxable account, capital gains taxes can affect your after-tax return. So tax consequences should be part of the decision, but they should not become an excuse to hold a deteriorating business indefinitely. Imagine the thesis has clearly broken, but you refuse to sell because you do not want to realize a taxable gain. You are now accepting potentially much larger investment risk to avoid a known tax cost. Sometimes that works. Sometimes the stock falls far more than the tax bill you were trying to avoid. The analysis is also different inside retirement accounts, where trading can have very different tax consequences. So think about taxes intelligently. But first, ask whether the investment itself still deserves to be owned. Tax efficiency cannot repair a broken business thesis, and evaluating that thesis correctly requires separating something investors constantly mix together: the stock price and the actual business performance. A falling stock does not automatically mean the company is failing, and a rising stock does not automatically mean the business is improving. Price and fundamentals interact, but they are not the same thing. A stock can decline because interest rates rose and valuations compressed while the underlying company continues growing. That can potentially create opportunity. A stock can also rise because investors became increasingly optimistic even while the business fundamentals quietly weaken. That can create risk. So I separate the analysis into two questions. What is the business doing? Revenue, margins, free cash flow, competitive position, and balance sheet strength. Then, what is the market pricing? Valuation, sentiment, expectations, and macro conditions. Price tells you what investors are willing to pay. Fundamentals tell you what the business is actually producing. And the difference between those two is often where opportunity or danger appears. That difference becomes especially obvious every earnings season. One of the most confusing experiences for newer investors is watching a company report good results and then seeing the stock fall. Suppose revenue grows 30%. That sounds fantastic. But imagine the market was expecting 40%. The company grew, the stock can still fall because the result was worse than what investors had already priced in. This is how expectations work. Stocks do not react only to whether results are objectively good or bad. They react to the difference between reality and what the market expected. And the higher the valuation, the higher that execution bar can become. A company trading at an enormous multiple may need exceptional growth simply to justify the existing price. Good results might not be enough. They need to be good enough relative to expectations. That is why valuation and fundamentals cannot be analyzed separately. And because expectations constantly change, you also need to know exactly what would cause you to stop owning the stock, ideally before you buy it. Before buying an individual stock, write down what would invalidate the thesis. Not what price would scare you. What business development would actually make the thesis wrong. Maybe margins deteriorate structurally. Maybe the company loses its competitive advantage. Maybe debt becomes dangerous. Maybe unit economics stop working. Maybe a new technology permanently changes the market. These are thesis-level problems. A 20% stock decline by itself is not necessarily one. If the business remains strong and valuation improves, a falling price can actually make the investment more attractive. But if the fundamental reason for owning the company disappears, refusing to sell because the shares are down is backwards. This is why exit criteria should exist before emotions arrive. You want the decision rules established while you are still objective. And if that level of monitoring sounds like more work than you want from your portfolio, there is nothing wrong with choosing a different game entirely. Broad market ETFs. Individual stocks and broad ETFs solve different problems. With an individual company, you accept company-specific risk in exchange for the possibility of outperforming if your analysis is correct. But that requires research, monitoring, valuation discipline, and the willingness to change your mind. A broad market ETF spreads company-specific risk across hundreds or thousands of businesses. You give up the chance that one brilliant stock pick transforms the portfolio, but you also reduce the chance that one corporate disaster destroys it. That is why one reasonable structure is using diversified ETFs as the core while keeping individual stocks as smaller satellite positions. Not because that framework is perfect for everyone, but because it separates long-term market exposure from active stock selection. Before buying any individual stock, I would ask, why do I want this company instead of simply owning the index? If you cannot answer that clearly, the broad ETF may already be doing the job you need. And if you still want the individual stock, run one final checklist. Before buying any individual stock, I want 6 questions answered. How does the company actually make money? Why should earnings grow from here? What future success is already reflected in today's valuation? What could permanently break the thesis? How much can this position lose without damaging the overall portfolio? And finally, would I still buy this stock today? That last question becomes especially useful after you have owned a company for years. If the answer is no, ask yourself why you are still holding it. Sometimes there is a legitimate reason. Taxes, portfolio construction, a temporary valuation issue. But sometimes the honest answer is simply emotional attachment. The checklist cannot guarantee good returns. What it does is force a repeatable decision process. Process first, ticker second. And that brings us back to the mistake that started the entire discussion. Do not marry your stocks. Buy with a thesis. Monitor the evidence. Update your view when new information arrives and act when the facts materially change. Conviction should not remain constant simply because you already own the shares. It should rise or fall with evidence. Position size should control the damage when your analysis is wrong, and valuation should always be part of the expected return equation. The company does not know you own it. Management does not know your purchase price, and the market owes you absolutely nothing. So the biggest mistake retail investors make is not buying a stock that eventually goes down. Every investor will do that. The bigger mistake is refusing to admit when the original reason for owning the stock no longer exists. Good investing requires conviction. Great investing also requires the ability to change your mind.